Oh boy, folks, we got two good ones to get into tonight, okay? Oh yeah, we have somebody that has been incredibly bearish on the market just turned to the bull side. So we're going to listen to what this gentleman has to say here. Why is he turning full bull now at this point in time, okay? And he is very bullish about the next 3 months for the stock market. He makes a lot of actually really good points, and I want to react to that. But even more important than that is the stance of going from bullish to bearish. I'll explain that in detail and why that matters in such a significant way, okay? Then we're going to watch this one from today. The S&P will fall to 3,300, says the chart master. Oh, the chart master's back. So we'll hear what he has to say. Why is the S&P 500 going to 3,300? Love to hear kind of his opinion and give my points off of that. Hope you guys enjoy this video. As always, if you're looking to join us in the private stock group this week and you want access to the Discord chat where you can chat with Palantir shareholders, SoFi, Tesla, Meta, AMD, all the other good companies out there, as well as get access to our private group investor report, as well as get access to all our course curriculums. Check out the pinned comment down there and apply to join us in there. Appreciate everybody joining me as always. 14,500 or 600 subscribers now at this point. I appreciate each and every person being subscribed to the reaction channel. Let's get into this. It's going to be a good one.
I want you to listen to you, and I want our viewers to as well. Just 10 days ago, September 22nd, listen.
You know, our conviction at this level is as high as it was when we were 1,000 points higher when we were bearish at the beginning of the year, bearish at 4,300 and now at 3,780. If you ask me, based on this current information, where the S&P would be, I would tell you that we should be much lower. I'm very surprised that we have not sold off as yet, but I think it's coming. If you wait 6 months, I don't think you're going to be in your best case scenario. I think you're going to be where we are right now. And in, you know, what I think is the base case scenario is that we're much lower. The higher the market goes, the more aggressive the Fed is going to be. And the same token, the lower the market goes, the less aggressive they're going to be. But the bottom line is that it's a lose-lose situation. If we go higher, the Fed gets more aggressive. If we go lower, then obviously we're going lower and you know, it's not going to be profitable to own stocks.
All Listen to how his conviction was so strong at that time, right? Very, very strong. And geez, you're about to see a 180-degree different individual here.
I feel like I should ask for your ID. I mean, are you the same guy? How does that guy who said all of that now say that you have turned tactically bullish for a 3-month trade?
So we're very
such a flip-flopper. In all fairness, I actually respect you know, the change of stance. I respect that.
And our conviction is very high. And so what has changed? So, you know, we look at the market very unemotionally, and we check our views every single day based on the information that's out there. And what we're seeing right now is the following. Inflation, real time, is falling sharply. And I can run through all the different aspects of inflation, but every single data point in inflation is falling month over month.
Which it has been.
Yes, now it's continued with rents and with now homes are finally, home prices are finally, you know, turning over. We think the Fed's last hike is going to be December 14th. And the reason why is part of the contagion that we've seen in the last week since I came on last time, I think is one of the 3 components that's going to lead to the Fed having their last hike beyond December 14th. So we're a mere 2 months away from this Fed hike cycle being over. And then
that is so important what he just said there, okay? Do not underestimate the words that just came out of that man's mouth, okay? And the reason you can't is if this becomes what he just said there, if over the next month, let's say for instance, that becomes most of Wall Street's opinion that the Fed is going to stop raising rates at the very end of this year, that changes the market dynamic in a massive way in how much risk basically Wall Street's looking to take out there, right? And so that is very, very interesting that somebody like him is now coming to this standpoint where he feels like the Fed's about done in terms of raising rates. They're getting, you know, 2 months away, let's say roughly. That matters in significant, because I'm telling you, if that becomes the conventional wisdom that is thought out there by Wall Street, the market's going to make a massive epic move if that becomes the thought process, because everybody's going to get way ahead of that, you know, and by the time the Fed actually, you know, basically let's call it stops raising rates, the move will have already happened, the massive move in regards to stocks in the market in general. So he might be a little early here in that thought process, but if this becomes the norm, oh my gosh.
The capitulation indicators have all shown up in the last 10 days, where you had the VIX hit 34, you've had the VIX curve invert, you've had the RSI go well below 30, and a number of others that all suggest that we are going to have a sharp
okay,
bounce.
let me take those one by one,
Sure.
if I may.
Sure.
Last time you were on, you said, and I quote, the Fed stopping is not a reason to buy equities. Now part of your bullish thesis is on the Fed stopping. Square those 2 points.
Sure. So the market, there's sort of the medium term and there's the short term. When this market gets a whiff that the Fed is almost done, the first reaction is that we are going to have a sharp rally. Even though in the long term, we're going to have to live with 4.5% Fed funds rate or 4.25% Fed funds rate for a amount of time that overall is going to put a damper on the economy. But the first thing that the market's going to do is it's going to rally on that. And one of the things that I look back on is there's been 4 times when the CPI has gone above 6%. When it starts to fall, markets V-bottom every time. It happened in 1970, 1975, 1980, 1990, and these were V-bottoms. So the market is going to smell inflation is done, Fed is done, and the first reaction is going to be market rallies.
You said capitulation is not close, right? When you were on last. We're only 70 points below that. The VIX.
The way he's talking right there, okay, this is a Wall Streeter talking. He's definitely early in his thought process around this. Most Wall Street isn't even on his frame of thought here. Let's call it what it is, okay? Most Wall Street is incredibly bearish still at this point in time, okay? But things on Wall Street actually changed rather quickly. And so a man like this starts it off. And then another Wall Streeter thinks, hey, you know what? He's making some good points. I think he's onto something here. And then a third Wall Streeter thinks that, and a fourth, and a fifth, and 10, and 20. And that's how this sort of cycle goes. And you have everybody flood to that bear side. Everybody's over there, right? Market's only going down, sell stocks. And then slowly, you kind of steal one bearish person over the bullish side, and then another one, and then another one, and then another one. And that's how the markets work. There you go, folks. You don't need to go to university. You just learned how the market works.
34. I mean, it's not like that's not capitulation, right? You know that. I mean, 70 points from September 22nd when you were last on. Now we've reached capitulation?
Yes. So here's capitulation. 10-year yields hitting 4%. The British pound hitting 1.04. MBS spreads going to 85 basis points, and retail selling big in the month of September. And so as much as I thought the low in this market for this year was going to be lower than where we closed on Friday, I was looking at all the different data points, and I said, you know what, a lot has been thrown at this market. Ran through all the stuff that we just talked about, and the result is I don't think we go any lower this year. So that's where we stand.
You had contended that there was better competition for stocks some 10 days ago, whether it was bonds or money markets, which finally offered an opportunity to investors that they hadn't.
For CCL's down at 6s. Holy smokers, that ain't no jokers.
Better part of at least the last decade or so. That's changed.
So I think that trend is going to be here, where money is going to, big picture, be on the margin flowing into money markets. And that's part of what we saw when there was selling in September. However, I think right now we have a 10% move, maybe greater, between now and the end of the year. And
10% in the S&P.
In the S&P 500. We went bullish this morning, so we've gotten a couple percent already. But I think we have that kind of move, and that kind of 1/4 move certainly.
Yeah, a 10, just to justify that, a 10% move, let's say in the S&P 500, if that's accurate, that's more like a 15, maybe 18% move in the NASDAQ, which means some of those growth stocks, some of those more speculative stocks will move 30 to 75% on that in a matter of 3 months. If that's accurate, what he's saying, and what he thinks the S&P 500 is going to there. That's interesting.
Dwarfs what you can get in money market funds, but I'm not backing away from that longer term trend, which I do think will exist, which over time I think money will move out of equities, a portion of it, out of equities and into money market funds.
Interesting. Okay. So the interesting part of that is he didn't even mention, I think, two extremely important things. One is the fact that usually in midterm years, the market goes beast mode in November, December. He didn't even touch that point. So that's something we obviously have going for us there, right? He didn't even touch the fact that we sold off massively going into earnings season, which could make things very, very interesting. When you get that massive sell-off, and then if companies just come in with decent numbers, never mind if some companies report good, that really matter for the market. That's huge. He didn't even touch on the fact that we're going to likely see margins start to improve for a lot of the smaller companies in this quarter, but especially going into next quarter, in the fact that their commentary is going to be much more bullish than we've seen it in at least a year, if not 2 years, for the smaller companies. So he didn't touch any of that. And I thought he still brought out a lot of great points there, right? And so this is why I say, if I was a bear, I would be covering everything left and right right now, because I think the risk reward it's very, very risky, I think, on that other side now at this point in time, when you add up everything that's kind of going on there. And, for Wall Street to put some buying pressure on this market, if a few more folks start to take his view on the market, right? And then a few more, and then a few more. You got to understand the rally that could be behind that, because Wall Street has to start chasing, and I explained this in a video a few days ago, they have to start chasing after each other. And so if all of a sudden the markets goes up, and so many of these funds are way underweight right now, if the market starts making a big upward move, the next fund has to get on. And it's like a buying spree that happens into the end of the year, so they can try to keep up with the S&P 500 at that point in time, because you can't underperform that bad. You can, but you're not going to get your bonuses. You could lose clients, and it's not an ideal situation, right? And so I thought he brought out a lot of good points there, but he didn't even touch on I think some of the most the important factors. And I wouldn't mind it if we had a beast rally for the remainder of the year. I would allow me to cash up a little bit, and because I've been such a heavy buyer, obviously, this whole year, so I wouldn't mind that. But the interesting point is what happens then in 23. Let's say we have this hypothetical kind of beast rally into year end for the last 2.5 months a year. Okay. What does that mean for 23? Well, 23 could be interesting because expectations are extremely low, which I love going into a year where expectations are extremely low. And if you look at Wall Street's expectations going into next year, very, very low, and getting lower, to be honest. I like that setup. Also, I think so many of these small cap companies are going to see massive margin improvement, cash flow improvement, and profitability improvement because so many commodities have come down massively. Container rates have come down massively. Transportation in general has come down massively for trucking and things like that. And so that's a whole massive push to small caps that have been the most beaten down. And if you're thinking about the stocks that are going to have the most potential upside in 23, it's certainly those sorts of stocks. So, there's just a lot there that, obviously it has to play out, right? You have to kind of let these things play out, and they'll go where they're going to go, okay? All right, next one up here, bearish video. I'll try to keep it balanced, okay? We're going to hear bear side, bull side. This one, I'm guessing, is technical related. The chart master is saying S&P's going to 3,300. All righty, for my bears out there. All right,
Master re-upping his message from April. Expect some red arrows from here. Let's bring in Carter Worth of Worth Charting for much more. Hey there, Carter.
Hey, Frank. Thanks so much. Well, I think we know that there is this hope, right, that because the dollar has cracked a bit and that yields have come in, that somehow the S&P is off to the races. I think it's going to be dollar lower, yields lower, and equities lower. Look at this first chart. We know how well-defined these lines have been. The bull case, not mine, look at the next chart, that we were to have yet another rally, and that rally takes us right back to the downtrend line in effect since the Jan 4 high. If that's your premise, not you personally, you generically, you're talking about 8% up from here. The bear case, that we crack, that we don't sort of bounce, put in double bottom, you can see it on the next chart, and that we are heading down into the 3,300 plus minus level. I think that is the scenario that's likely. But we certainly know this, that there are a lot of people on both sides, and it will be determined one way or the other. Let's talk about yields, because that seems to be the...
I mean, all of us folks that are buyers of the market, it doesn't really scare us. 3,300, bring it on, cheaper stocks, and that would just produce large caps to be even cheaper, which large caps are getting actually back to very interesting forward Ps. I mean, you're starting to see it back to ranges we were 7-8 years ago now at this point in time. So even large caps have gotten very interesting over the last few months because of this big market fall, specifically over the last 2 months. So if we're talking about 3,300, that was just the way you get there is from large caps falling more, and so wouldn't be against it. I don't think it's very realistic, but I would not be against it. It just means stocks for cheaper for a buyer that has more of a long-term perspective.
That is the flavor of the day. This is a very minor short-term chart, basically since August 1, and the dip in yields leaves us right on trend. Now, could we go a bit further? Yes. Take a look at this longer-term chart, and then quickly to the final chart. What we have is a dip that leaves us almost back to that spike high of June. The real question...
All these charts always work, by the way, until they're broken, and then they get thrown out, and then it's like, oh, crap, no, that one got broken, okay.
Are we headed materially lower? I think so, and I think that while that would be considered on the surface a positive for equities, it actually is going to be something quite the opposite.
All right, Carter, just to be clear, your point of view is the bear case in this situation. The S&P falls about 10%. So is key to that interest rates continue to climb, or are there other things that could make your bear case turn out to be true?
No, I'm saying I think you've reached the point where you're going to have interest rates not go higher, and equities are actually going to realize that it's for the wrong reasons, and equities go lower as well.
All right, Carter Worth.
So, I mean, he's asking a gentleman that's obviously very in the technical world about fundamental things. I just think, you got to diverge those things. His name's a chart master, okay? So he's going to look at the technicals, and he's going to say, okay, I think, this is going to happen based upon this, and here's a support line, and all those sorts of things, right? And then you have a fundamental side that's a very different thought process, right? And so, I mean, asking a gentleman like that to give a, reasoning behind fundamentals and things like that, I just think are misguided. It's the same thing if you ask me about technicals. I'm like, I could talk about it, but it's not my specialty at all, and it's not what I focus on, right? And so it's just that's why I just stay out of that game. I don't give my opinion on technical data or anything like that. It's not my realm. I like to focus on kind of the fundamentals, and I like to focus on the psychology of the market, and especially around sentiment, right? In those sorts of things, because I think that's obviously very important. And technicals can be important mainly because people give technicals value. That's why technicals are important, because there's a lot of traders and a lot of folks on Wall Street that look at these technicals and they put value to them. That's why they matter, because people put value to it, no different than the dollar, right? Oh, man, the shots at the dollar, shots.
Appreciate it. All right, let's trade it. Karen, I'm going to come over to you. I was looking at the monitor while Carter was talking, and you were kind of looking at his thesis there. What's your take on what Carter's saying there?
Well, so it's very interesting. Carter's obviously really good at his job. I was wondering, does the bounce scenario mean the other scenario doesn't happen? And I'm wondering, could we see this bounce first and then the down lower past that trend line? And so that would be quite a big fall from a bounce. That absolutely could happen.
Yeah, you could always see something where, market rallies into year end, let's say goes back to just the S&P 500, let's say, goes back to 4,000 plus, something like that. And then all of a sudden New Year happens and people get bearish again, and then market moves down massively. Those are always possibilities. So you can't deny that that's a possibility.
I guess, my compass is I'm always long. So I'm always, more optimistic. And I think that if rates do go lower, that will inherently be good for stocks. I know he's saying that's not the case, but I think that it will be, particularly for the high flyers who've been decimated. That's not that's not in my portfolio, but I do think it would be somewhat of a floor for those stocks.
Julie, what do you think?
Some of those stocks already floored.
Yeah, I think it's an interesting point, right? Because to me, Carter's point is actually more fundamental. And it's, if interest rates are declining because the fundamentals are deteriorating, inherently that's problematic for equities. And, I agree that there is so much desire to tick the bottom. And that seems to be what drives all of these rallies, is this idea that, we've reached it and we're all going to jump in all at once. And I think we just have to let the fundamentals play out, because it's important to keep in mind that the rally that we experienced over the last 2 or 3 years, yes, fundamentals were good, but a lot of it was valuation driven.
She looks like she could be my sister.
Connected to low interest rates. And so we're still not at a point where equities are really that cheap. And so it's hard to get really bulled up and enthusiastic.
I don't agree with that. What metric are you looking at? I just don't agree with that at all. I think especially small caps and mid caps, you can't even say they're fairly valued. They're massively undervalued when it comes to smalls and mids. Large cap, if you look at large cap, I feel like we're fairly valued or slightly actually undervalued now at this point in time. So I just don't. I 100% disagree with this notion of like we're overvalued, or where there's no deals in the market. Like what? No.
You haven't had this real capitulation where you threw out the baby, the bathwater, the whole bathroom. We're just not there yet. And I think it's just going to take time for that to circulate through the fundamentals.
I bring this back. The only way you're going to get this, and this is like the thing on Wall Street, that everybody keeps talking about. We need that VIX 40 plus. We need a massive capitulation VIX type day. You're only going to get that if you get a crazy epic event happen, okay? Such as Lehman Brothers and all the, AIG and all Salomon Brothers and all those folks that went down in 2008, and you got the VIX to spike massive in the fall of 2008. Or such as, obviously, the Rona crash, where it's like all of a sudden, this thing came out of nowhere, and then they were like, we're going to close down the economy for the next few years. And people were like, what? Like, what? How many companies are going to go bankrupt? And people were very concerned. It's very hard to get this VIX to go 40 plus again without a shock and awe event. It just is. And so this fixation about, we're going to have the VIX go insane. It's just, I don't want to say it's misguided, because it can always come, but you need a shock and awe event. And if you're going to hold your breath on shock and awe events, they don't come that often. We had 2008 shock and awe event. Then when was the next real shock and awe event? 2020, okay? Are we going to have another one? We could, but usually you have to wait like 10 years between these things. They don't happen that often. So that is something to keep in mind there. Yeah,
capitulation has been a big word for this market in recent months. Guy, are you agreeing that we're still a good ways away from the moment of capitulation?
I haven't seen, the only panic I've seen over the last, except for a couple days since January, has been to the upside. And I'm not suggesting today was panic at all, but you have seen, typically we associate a panic with selling. I would say since January or so, you've seen panic buying at least 4 or 5 different times. So let's put that out there. I don't think we've seen capitulation to the downside, number one. And, I think there's this misguided belief out there, and I'm not suggesting anybody on this panel says that, but, somehow if the Fed does pivot, all our concerns of going away. That's not the case. The reality is we're in a period of slowing revenue growth, slowing earnings growth, and how much you're willing to pay for this earnings in this environment, and we're still too expensive. So earnings are going to come down. We're seeing a slowdown right before our very eyes. And even if the Fed were to pivot, it's not going to cure the ills that corporate America are feeling right now.
Yeah, I mean, every one of these crash scenarios is different, right? And obviously, you had VIX go mad at the end of 2008, in fall of 2008, because of all the massive Wall Street failures, right? And almost losing the entire financial system. Guess what? You have an event like that, oh my gosh, everybody's going to flip out, okay? But I mean, look at, for instance, the tech bubble blow up there, right? In the tech bubble blow up, so, VIX went insane here in 98, right? But things, in terms of the market going down, it started in 2000 and it led all the way through 2002, essentially, okay? And look at the VIX, all the way the market melted down. You never had the VIX go crazy. I was looking right here, and you had VIX almost 40. Roughly there at the very end of that crash. essentially, right? And so in this scenario that we've had recently, it's like we've had an elevated VIX. It's just like you need some sort of crazy thing to get this 40 plus VIX that they want, and it's just like, it's not easy to get that. There's, only a few times ever you can get that 40 plus VIX out there. Never mind if you want to look for a 50 or something like that. You need something crazy to come out. And so, I just think this has been a very orderly kind of sellout since basically it really started truly back in, it truly started back in February 2021 when obviously the growth stocks and the spec stocks all peaked at that moment in time, right? And ever since that point, it's been an orderly exit. Right out, smalls, then mids, now large, obviously, recently. And it's been rather orderly in the whole situation. And so that's when you're in more of a long, drawn-out situation, which is kind of what we're in, a more long, drawn-out situation. And so I don't even look at from a standpoint of expecting the market to have like a V-shaped recovery. And I know, like that other gentleman was kind of almost alluding to a potential V-shaped recovery. I don't really look at it like that. I think it's a possibility, but I'm looking at it more from a standpoint of like a gradual recovery that's going to have some downs in there and ups, obviously, right? And different stocks are bottoming at different times. There's already a lot of stocks in the market that have already bottomed months ago. And I point this out in the videos. I know the people that obviously watch every video I put out, and I appreciate all you guys that watch every single video. You guys have seen this, and I've talked about this, about stocks and I've shown you stocks that already bottomed months ago and are already up 20, 30, 40, 50% since that time, despite the market hitting new lows. And so over the next year, there's going to be some stocks that just perform ridiculously well and give some incredible gains off that people never saw coming. And there's going to be some stocks that just do very poorly that, people are like, what? How is this stock doing bad? It was doing so well for a long time there, and now it's faltering. It's the way it works in one of these more orderly, long drawn out kind of cycles. Let's just call it that, cycle of the market, okay? And so I think that is something important to understand about the current cycle we're going through. So with that being said, I appreciate everybody for joining me as always in today's video. If you're looking to join us in the private stock group, check out the pinned comment down there to apply and get access to all our Discord chats, to the private group investor reports, to all the course curriculums and things like a lot. Much love and have a great day.